Hi guys, I hope everyone's doing well. I wanted to put together a video for the properties that we were advertising on Facebook. You may have downloaded a brochure and you're looking through it, and I thought I'd do a video just to sort of provide a bit more information on the properties itself. So if you were to pull up the brochure, you will see that there's 4 townhouses in Woodville Gardens. They're actually on 8th Avenue, which is, if you look at this map, in between Hanson Road and Days Road. So Woodville Gardens is located approximately 10 kilometres out of the CBD, and it's about 9 kilometres away from the beach. So it's well within that golden triangle that we're working with in South Australia. So from an investment point of view, there's some really good potential in these areas, in these western suburbs that are going through quite a bit of gentrification. Now, 8th Avenue in particular, if you have a look here, you will see that this is the location right there. So it's 53 to 55 8th Avenue. If you were to drive on site, you will find that all of these houses have actually been knocked down. So they were government housing, it's all been out now, and obviously the new is coming in to replace that. So you'll find a lot of that scenario happening all throughout the western suburbs. That's what we refer to as gentrification, when the old is going out and the new is coming in. Now, if you're looking at buying this as an owner-occupier, you'll be happy to know that this particular location is within walking distance of schools, shops, transport, and all the conveniences that you would expect. So in particular, you've got the Woodville Gardens Primary School, which is well within walking distance. You've also got Arndale Shopping Centre, which is also within walking distance, and there's plenty of transport all the way through as well. So you'll see there's bus stops in nearby locations. Now, back to the brochure itself. Now, as I mentioned, there is 4 townhouses. They're all 3-bedroom, 2-bathroom, double garage with 2 living areas, and they are turnkey properties, meaning that they're completely finished, built, and ready to move into. There's nothing more that you would need to do to finish these properties off. That includes landscaping, fencing, driveways, pathways, air conditioning, appliances, overhead cupboards, wardrobes, TV antennas, clotheslines, letterboxes, the whole lot. We can literally get the key from the builder, move our furniture in, and start living there. Now, if you're looking at this as an investor, you would be happy to know that Woodville Gardens has actually increased by over 18% in the last 5 years. The rental yields in the area are quite strong. We're talking upwards of 4%. And when you combine it with the potential of what is happening throughout the surrounding suburbs, and couple that with the gentrification that's going on, we are expecting some good things for our investors who are parking their money in Woodville Gardens and in those particular suburbs. Now, in terms of the features of the property, they are built to a really nice inclusion level. So we're talking 2.7 metre high ceilings, stone bench tops throughout the property, ducted reverse cycle air conditioning, stainless steel appliances in the 900mm canopy range hood. Talking about laminate flooring throughout the house, and then carpets in the bedrooms. It's got curtains and blinds included, your walk-in robes, your ensuite. Everything's all finished off, and even your driveways, your fencing, and your landscaping and your stormwater. Everything's all included. Now, in terms of the floor plan itself, if you have a look here, you'll see that there's a few different designs. I'm going to show you the floor plan for number 1, because that one there is actually a nice little build, and I just want to show you the sizes so you get to see what it is. So in terms of the land area, we're looking at about 19.8 meters by 14.2 meters. So the land itself is reasonably low maintenance for the size that we're working with. The actual property itself comes up to 205 square meters of living. Now, 205 square meters of living is actually a really good amount. If you have a look at, let's say, the living area itself, we are talking of approximately 74.57 square meters of living space downstairs, and you've got approximately another 74.5 square meters upstairs as well. So you've got a reasonable amount of space. This is excluding garage, porch, and any landscaping as well. So downstairs, when you look at it, you can come through. There is a side that you can obviously drive your car and enter in through the driveway into your double garage. The entry for this particular one is coming from the side. So this is a street-facing entrance. So as you come through, you've got your bathroom to the side and the laundry to the other side. If you go down the corridor, at the end of the corridor, that'll take you upstairs. There will be a linen cupboard underneath the stairs and some understairs storage right there. If you turn left, it'll take you through to an open plan for your kitchen, meals, and family area. Now, it's a decent-sized open plan living area with double sliding doors that lead out to the backyard, and you've also got a walk-in pantry to the kitchen. So this has definitely been a popular choice for the people who are looking at buying in there. When you look upstairs, as you come up the stairs, you land in the retreat area. So it's called a retreat area. You can put a TV up, TV and some couches. You could put a study room up there. You can put like a little play area, depending on what you want to use it for. It is considered a second living area. If you turn right, you got your master suite. Now the bedroom itself, you're talking about 4.2 meters from wall to wall. That's excluding the walk-in robe and the ensuite. And we're looking at about 3.3 meters from the other way as well. So you've got a big walk-in robe behind the bedroom. So you've got a massive walk-in robe, and then you've also got a big ensuite as well, which has double showers, double basins, toilet, and it's all self-contained. Now, if you come out and you go into bedrooms 2 and 3, you're looking at 2.99 in terms of the width, and we're looking at 3.945 and 4.675. So we are talking about big bedrooms. They're not your puny 2.7 by 2.7. These are decent sized bedrooms, and they've got built-in robes with the shelf and rail installed in there as well. There is a shared bathroom, which has, again, a big sized shower, a toilet, your basin, and the bathtub, and this will have a skylight as well. Due to the boundary builds, so obviously wall to wall, there will be sufficient lighting throughout every room of the house to ensure that you're minimizing on your power bills. And we've also got some more elevations as well. So I can send some of these through. As you can tell, the builder on these properties is Elite Homes. Elite is a South Australian owned and run company. They've been operating for many years, putting out good quality product and offering fixed price turnkey packages to their investors, their first home buyers, and their own occupiers as well. So this concludes the rundown of the brochure. Now, what I want to do is show you from an investment point of view what the numbers look like, because I believe the numbers are important to consider. So here is one that I've done earlier. This is a previous example. And basically, if you were purchasing one of the properties at $445,000, we're assuming that the purchase price is in line with the market value, although we believe that the value is actually going to be a little bit better than what we're buying it for. The building inspection is factored into the due diligence cost, because we believe in getting a report to ensure that you know the state of the property at the time of you purchasing. Now, in terms of settlement costs, We can obviously change this depending on how much deposit you want to start with. So some people are starting with 5% deposit, some are starting with 10, some 15, some 20. I'm going to take an average of 10% just to keep it on the easy side. We've also got our stamp duty factored in, which is just under 23,000, and we've got our conveyancing costs, which is your solicitor's fees for handling the transaction. Now, we've also allowed some money for the setup fees for the loan and allowed a little bit of money for LMI, which is your lender's mortgage insurance. So if you're borrowing more than 80% of the value, then you will have to pay lender's mortgage insurance, which is a cost that comes from the lender, and it just gets tacked onto the loan. Now, the third part of your upfront costs is any improvement or selling costs. So because this is a brand new property, there is no improvement costs. You're not doing any renovations or anything like that. Your selling costs, if you decided to sell the property down the track, we will allow 2.2% for an agent's selling commission. Now, that will only take effect if you sell the property. When we look at the rental income and your expenses, then this is what we're working with. So the rental income that we've got forecasted on this is around $450 per week. However, I want to be a little bit conservative and drop that down to $440 per week. We also are expecting 2 weeks vacancy every year. So 2 weeks of the year, we have changeover of tenants. We might have some downtime and or advertising it, trying to find new tenants. So we're expecting 50 weeks of the year to have rental, which is going to equate to about $22,000 a year. In terms of our expenses, we've allowed $1,400 a year for rates, which works out to be $350 per quarter, which is in line with the council guidelines for this particular property. Now, land tax is subject to individual circumstances. So if you own a lot of properties and you're purchasing this as another one, then I would recommend you get some accounting advice from your accountant to work out how to structure this, whether we have to create another entity to purchase this under, or whether the structure of this is going to be dependent on your accountant's advice and based on your situation. Now, the third part of it is the building and landlord insurance. So now we always recommend having sufficient building insurance and landlord insurance in the event that you have a loss of income due to tenant defaulting or tenant damaging the property or whatever it is. So for $900 a year, that should cover you for the building and landlord portion. Now, because these are community titled, there is no body corporate, and there's no strata fees or anything like that. There's no repairs or maintenance. There's no cleaning contracts or service contracts or garden and lawn maintenance. There will be a letting fee of 1 week's rent, and we're looking at SA water supply charges of $300 a year, and property management is approximately 8% per annum. 8% on all the money that's collected. Now, the next part of this is your loan structure. Now, in this example, we have structured this loan on interest only. The reason we've done this on interest only is because most of our investors that come to us and start working with us generally have their own home loan, and their home loan is a non-tax deductible debt. Their investment loan, on the other hand, is fully tax deductible. So what a lot of our clients prefer to do is to keep their home loans on principal and interest and pay a bigger portion of principal of their home, and then keep them interest payments or keep their repayments on the investment property as low as possible by keeping it interest only. Now, the loan term for this property is calculated over 30 years, and we're going to do this as a 90% LVR, which is 90% loan to value ratio, meaning we're borrowing $400,000 against a $445,000 property. The next part of it is working out the interest rate. Now, as you can tell, interest rates are at historical lows. They've never been this low before. I've seen interest rates in the high 2% at the moment. As an investment loan, we will allow about 4% though, to make sure that we've covered most scenarios. And then equity and line of credit is not applicable in this example. So that spells out the income and expenses for us. The last part is down to the depreciation, the market factors, and the taxable income. Now, in terms of the depreciation, that will be we would recommend that you get a schedule done by a quantity surveyor, to work out exactly how much you can claim each and every year moving forward. Now, the best thing about buying an investment property is that you'll have depreciation for the next 40 years. So an average house has a 40-year lifespan, and you'll get 40 years worth of depreciation. However, the way the depreciation is split up is in two portions. The first portion is the actual building itself. So we're talking about the frames, the doors, the roof, the walls, the foundation, everything like that. That depreciates at 2.5% of the build cost over a 40-year period. So hypothetically speaking, let's say that you bought a property and you built a property for $250,000. Let's say $200,000 was building, and then $50,000 was fixtures and fittings. So fixtures and fittings refer to things like appliances, air conditionings, curtains, blinds, carpets, anything that's a fixture to the building. And that depreciates at a higher rate. That depreciates between 10 to 20% over the first 5 to 10 years. So what happens is in the first 5 to 10 years, you're going to get the biggest amount of depreciation benefits as possible. And then from the 10-year mark onwards, you're always going to get your minimum, which is 2.5% of the build value over the remainder of the 40 years. So in this example, we've got a basic example of how depreciation looks like for this particular property. Now, the second part is the market factors. Now, one thing we know is that CPI averages around 3% per year. Now, CPI is your consumer price index. That means the cost of living, the cost of services, the cost of goods is always increasing. So what we do is we factor in a 3% price rise every year on all the services and products that we are working with. Now, then the other part is the average annual capital growth. Now, when you look at the average annual capital growth for property, if you were to backtrack over the last 100 years, you'll find that property tends to double every 7 to 10 years on average. That's historical data. If you were to work that out as a percentage, in South Australia, it's anywhere between 7 to 8%. That's the figure that we average. Now, that includes times where we have been booming and times where we have been on the down. So you got to understand that property is not a short-term investment strategy. It is a long game strategy. It is something that you park your money in for the next 10, 20, 30, 40 years. And if you were to go back to any investor who's invested in property in the last 10, 20, 30 years, I could almost guarantee that every one of them would be in a better position now than what they were 20 years ago if they invested in properties. So usually we ask people who would, if you could go back in time, who would buy more property? And 100% of the people we ask that question to always suggest that they would buy more property. Foresight's a great thing. And if we can, if we work on the presumption that history repeats itself and that we can expect property prices to continue to grow, maybe not at the same level that they have in the past, but at the very least, making sure that our asset is growing in value. So what we've done in this example is allowed a 5% capital growth, which is your CPI plus 2%, meaning that it's a conservative amount of capital growth to forecast. And then the last portion of this is going to be the ownership level and the taxable income of the owner in this example. So what I'm going to do is I'm going to keep this very simple, and I'm going to keep this example based on someone earning $100,000 a year. Now, it could be less, it could be more. I'm just going to take the average for now. Now, when we look at the actual report itself, this is what we see. Now, if we bought this property at $445,000 in 2019 with a 5% annual capital growth, over a 10-year period, this property is going to be worth approximately $724,000. So we're looking at roughly a $280,000 worth of capital growth over a 10-year period. If you were to average that out over the number of years, that's approximately $28,000 a year you are adding to your bottom line as a result of this property. So if you were to ask yourself, how much harder would you have to work to make another $28,000 a year in your job or in your business or whatever it is? Now, if you can do that through property without having to actually work for it, I mean, you will have to work for the actual property. It's not going to happen by itself. You'll have to maintain it and support it and manage it. And there's a few moving parts. But if you can make an extra $28,000 each and every year for you, would that be worthwhile? That's a question for you to answer. The second part is the loan and equity position of this property. Now, as you can see, the loan amount on this property remains at $400,000 all the way through. Now, when we first start off with a loan of $400,000 against a property that's worth $445,000, our loan to value ratio is sitting at 90% LVR, which means we've got $44,000 worth of equity in this property, which is our deposit, but we can't touch any of it because the bank needs that as security. If you ever look at the following year, when the property hits $467,000 as valuation and your loan amount still $400,000, that means your loan to value ratio is now 86%, which means you've got $66,750 worth of equity. However, the bank wants to retain the 10%, which they're working off initially. However, you'll have about 20 grand worth of available equity for you to be able to use to another purchase or anything else. Now, if you fast forward 5 years down the track, and we're looking at 2024, the property at this stage is forecasted to be worth 567. Your loan against the property is still 400,000, so it gives you a 71% LVR, which is loan to value. You will have 167,000 worth of equity, but at this stage, the bank is still wanting to retain the 10%, which gives you 110,651 as usable equity. Now, we can change this to an 80% LVR level, which means the bank will retain a little bit more equity in the property and free up about $53,000 for you. So it depends on your risk tolerance and how bullish you want to be, how many years you've got, and there's a lot of factors that it relies on. But ultimately, as your property grows in value, you're going to free up equity to use on other purchases. Now, the next part is your rental income. The rental income in this example is showing $22,000 worth of rent. That's based on $440 rent per week and 2 weeks vacancy. Now that gives us a 4.9% gross yield. That means you're covering most of your costs, and your net yield is sitting at 3.9%. So they're pretty good yields for residential property. Obviously, you can get bigger yields with commercial, but obviously the risk is directly associated with that return. The annual expenses in this example are your main ones is your loan interest payments. So on a 4% interest rate, you're looking at $16,000 worth of interest. Your property expenses, on the other hand, that's your rates, your insurances, your property management, and everything else that goes with it, comes to $4,800. So when you add up all your expenses, you've got $20,800 going out and $22,000 coming in. So pre-tax, before you've done your tax return, this property is positively geared by $1,100 a year, which is $23 a week. Now, in most cases, you would have had to pay tax on this money if this was an older property. But because it's a brand new property, we've got depreciation benefits. Now, we're starting with 12 grand worth of depreciation, plus you can add all your settlement costs and your transaction costs, such as your lender's mortgage insurance, your loan application fees, your legal fees. All of those costs are tax deductible. So when you add them up and you subtract whatever profit you've made from it, we still end up with $11,700 worth of deductions. So if we took that off your taxable income, you would, assuming that you earn 100 grand a year, that means your estimated refund is about $4,330. So when we add up the refund that we're getting from the ATO and the pre-tax cash flow that we've made before we've submitted our taxes, that means all in all, this property is giving us a $5,510 positive cash flow per annum, which works out to $106 per week. So there's three things that we're achieving in this example. Number one is we're getting capital growth of approximately $28,000 per year. Number two is we're making a positive cash flow of $5,500 a year. And number three is we're saving thousands of dollars in tax over the years. Now, I hope this example makes sense. I would welcome any questions, any queries, or any ideas that you may have for yourself that you want to flush out and unpack. I would invite you in for a strategy session so you can see this for yourself and we can role play this example with your numbers to suit your strategy. So if you'd like to do that, please reach out. You can give me a call direct. My mobile number is 0477 633 333. You can call our office. Our 1300 numbers, 1300 846 956. Whatever you prefer to do to reach out, give us a buzz. And I look forward to connecting with you and, working with you guys moving forward. All right, all the best for now, and we will see you soon.